The 20th and 21st centuries witnessed two economic calamities, the Great Depression and the 2008 financial crisis. These events, separated by nearly 8 decades, shared striking similarities in their causes, consequences, and responses. The Great Depression, beginning in 1929, plunged the world into a decade of hardship. The 2008 financial crisis, triggered by a collapse in the U.S. housing market, had a similarly devastating impact. Exploring these events reveals systemic weaknesses and the crucial role of government intervention in mitigating economic downturns. The Great Depression stands as a stark reminder of the devastating consequences of economic collapse. It was a time when the American dream turned into a nightmare for millions. Triggered by the stock market crash of 1929, it plunged the United States into prolonged hardship. The crash sent shockwaves through the financial system, affecting every corner of the nation. Rampant speculation in the stock market during the 1920s, fueled by easy credit, drove prices to unsustainable levels. People invested their life savings, hoping for quick riches, unaware of the impending disaster. When the bubble burst in October 1929, the crash wiped out billions, triggering a chain reaction. The financial markets were in turmoil, and the impact was felt far and wide. Banks heavily invested in the market failed, leading to widespread bank collapses. The banking system, once a pillar of stability, crumbled under the weight of bad investments. As banks collapsed, depositors lost their savings, and credit dried up, worsening the downturn. Families were left destitute, their financial security shattered. By 1933, the unemployment rate soared to 25%, with millions out of work. The streets were filled with the unemployed, searching for any opportunity to survive. The Great Depression left an enduring legacy, shaping U.S. economic policies and social safety nets. The New Deal programs, introduced by President Franklin D. Roosevelt, aimed to provide relief, recovery, and reform, forever changing the role of government in American life. The 2008 financial crisis was a product of financial deregulation, excessive risk-taking, and a housing bubble. Financial institutions engaged in risky lending, believing housing prices would rise indefinitely. Subprime mortgages were bundled into mortgage-backed securities and sold globally. When housing prices declined in 2006, the value of these securities plummeted, triggering defaults and foreclosures. The crisis exposed the interconnectedness of the global financial system, leading to a credit freeze and economic turmoil. Both the Great Depression and the 2008 financial crisis were fueled by rampant speculation. In the 1920s, stock market speculation created a bubble destined to burst. Similarly, excessive speculation in the housing market led to a bubble in the 2000s. Easy credit and a belief in ever-rising prices fueled these bubbles. When asset prices failed to meet expectations, the bubbles burst, causing economic shockwaves. These parallels highlight the dangers of unchecked speculation and the importance of sound economic fundamentals. The banking system plays a crucial role in a modern economy, but can also be a source of vulnerability. In the 1920s, banks invested heavily in the stock market, leading to significant losses when the market crashed. Bank runs and failures further deepened the economic downturn. Similarly, the 2008 financial crisis exposed risky lending practices in the housing market. As housing prices declined, banks held trillions in toxic assets, spreading the crisis globally. The resulting credit crunch severely impacted the global economy. Government intervention played a crucial role in mitigating the effects of both crises. During the Great Depression, President Franklin D. Roosevelt's New Deal programs provided relief and stability. The FDIC ensured bank deposits, the WPA created jobs, and the Social Security Act provided a safety net. In response to the 2008 financial crisis, President Barack Obama's TARP stabilized the financial system. Loans to automakers and a stimulus package boosted the economy. These measures were necessary to prevent complete economic collapse and shaped future government responses. Beyond statistics, both crises left an enduring legacy of human suffering. The faces of those affected tell a story of resilience and struggle, a testament to the human spirit in times of adversity. During the Great Depression, Unemployment soared to 25%, and families struggled to survive. Breadlines and soup kitchens became a common sight, as people did whatever they could to get by. The Dust Bowl added to the misery, forcing thousands to abandon their land. Dust storms ravaged the plains, turning once fertile fields into barren wastelands and displacing entire communities. The 2008 financial crisis led to a wave of foreclosures and 10% unemployment. The housing market collapsed, and many found themselves without a roof over their heads, their dreams shattered. Many lost their homes and jobs, facing financial ruin and uncertainty. Job fairs were flooded with desperate job seekers, and shelters struggled to accommodate the growing number of homeless families. The psychological toll was immense, with individuals and families grappling with a loss of hope. Mental health issues surged as people struggled to cope with the stress and anxiety of their uncertain futures. These experiences highlight the human cost of economic downturns and the need for policies promoting economic security. Community support and government intervention became crucial in helping people rebuild their lives and regain stability. The Great Depression and the 2008 financial crisis offer valuable lessons for preventing future disasters. These historical events highlight the devastating impact of economic mismanagement and the importance of learning from our past mistakes. Financial regulation is crucial to prevent excessive risk-taking and complex financial instruments. By implementing stringent oversight and transparent policies, we can create a safer financial environment that discourages reckless behavior. Sound economic fundamentals, including sustainable growth and responsible lending, are essential. Encouraging small businesses and ensuring banks lend responsibly can foster a stable economy that benefits everyone. Promoting financial literacy can help individuals make informed decisions. Educating the public about financial matters empowers them to manage their finances wisely and avoid pitfalls. These crises remind us of the fragility of the global financial system. They serve as a stark reminder that vigilance and preparedness are key to preventing future economic downturns. Vigilance, responsibility, and proactive measures are necessary to safeguard economic stability. Government officials and business leaders must work together to implement strategies that protect the economy. By learning from past mistakes, we can strive for a more resilient and equitable economic future. Collaboration and innovation are essential in building a robust economy that can withstand future challenges.